Happy Thursday, friends. Mortgage Mark here. This thing's probably coming to you later in the day because I've had some technical difficulties, but we will persevere. So let's talk. We got a lot of good stuff. Last week was really long. I know that. I had some feedback, some good, some bad. I understand. But it was a lot of good stuff. For the most part, it was overall positive. So we're going to do something similar. We're going to go through some really good charts. Rates are up 5.55, so lucky number 5 if we're in a slot machine with zero point 0.8 points. That's what Freddie Mac says. Guys, if you did watch last week, we kind of called this. We said we were right around here, probably not going to hold. And lo and behold, remember, guys, red is bad in this case. This is mortgage-backed securities. This is no bueno. We don't like this coming down here. Here's the only quote-unquote good news. And I forgot to draw my line. But if you draw a line straight across, you guys can kind of see this is a little bit of a level of support. Now, the reality is, I don't think it's going to hold. Even though we're oversold, we're down here. Let me show you the 10-year Treasury. So folks will say, oh, it follows the 10-year. It does. There's correlation. It's not always the case, but in this case, check this out. You got this run of the 10-year, and now the 10-year is up here, and I'm predicting, and unfortunately, it depends on what Powell says tomorrow, but I was predicting this may go to about 3.25, which will put you up here, meaning rates are going higher. But you guys can kind of see how it's had a run. It's now above its 50-day moving average. So it's above here, so that may hold. It may come down. Maybe Powell says something good and it sits here. But I don't think we're going to have a huge decline, even though we're overbought. Right? You can see down here the red and the black. We're overbought down at the bottom. So you think that maybe we can have a nice little, rates can float back, maybe get the 10-year under that 3%. And then coming back to this is the S&P, guys. Remember I said last week, here we were at the 200-day. I predicted, and rightfully so. Now I'm not right all the time, every time, so I'm not saying that. But you guys can see how cool these technical signals are. When they hit 200, moving at 200-day, it bounces down, and now here we are fighting now the 100-day moving average. So again, you guys can see how these lines. It's just weird how they really do behave. Like they're when they're above you, they're a ceiling. When they're below you, a floor. So where do we go from here? Tomorrow, when Mr. Jerome Powell speaks, we're going to find out what happens. But here's some interesting charts I saw this week. M2 is how it's a measurement of money that the average or just Americans have, right? It's your checking account, savings account, money market, all that stuff. So it shows how much money we have in our pocket. And this is the percentage change in the blue, this little squiggly line. The 60-year average is right here in your orange line. As you guys can see, COVID hit, and obviously the savings went crazy high because we didn't have anywhere to go. We didn't have anywhere to eat. We had to just sit at home and do nothing. And you can see the amount of how just savings grew and grew and grew. Now you can see how all that savings has been depleted. I'm sure some of it's through travel because everybody's doing that. Inflation certainly a big component too, right? We've all seen it at the grocery store. It's just things are expensive. So you can see how we're now coming back down to this average. And again, guys, not to say this is recessionary, but when people don't have the same amount of savings in the bank, they may start spending less, which will slow the economy down. So in a weird way, this could be good for inflation, right? So when we're not out there just spending money like crazy people, going on vacations and buying all that stuff, going out to eat every night, this may be helping inflation. So a recession, unlike any other, as we mentioned, GDP, 2 consecutive quarters. That's the general consensus. That's not the technical one, but that is the general consensus of what a recession is, and supposedly we're in one. So guys, here's the deal. The U.S. personal income, you can see the trend in the orange again. They kind of just match, and all of a sudden again, take the pandemic and look what the income has done. It's just gone up and up and up, like significantly, more pronounced than any other time since 2005. And again, some of this is because of labor shortage. You got to pay people more. Some of this is because maybe people are getting cost of living increases in their income. But it's just really interesting to see that deviation of where it's been over the last 15 plus years. Millennials. So here's why I think home growth, housing is still going to be okay. Unlike, the mortgage meltdown back in the day where there were way too many houses, not enough people. Guys, check this out. This is a population, this line is the population of people between ages 30 and ages 54. Why? Because those are the prime home buying years, right? The generic or general, home buyer, the majority of them are going to fall in that 30 years old to 54-year-old category. The sub 30 market, you're going to have folks buying, but typically when you're 30 years old, having a baby, all that stuff, it promotes buying a home. So this is the population in America since 1940 of the amount of people that are somewhere between the ages of 30 and 54. The break right here is where the projections kick in. And because the number of millennials that are out there, as they age and get older, check that growth, right? We've been flat for the last, call it two decades. But all of a sudden, here you go, it's going to start taking off between the 30 and 50-year-old public. So again, those people can and will need to buy houses. So I do think that's going to be a good sign. Here it is for the world. The same stat, well, slightly different. Working age from 15 years old to 64. So maybe the child labor in the other countries. But you got to where this is the population from 15 years old to age 64. So that means that in 15 years from now, this population may be buying homes. But check this out, and I'll leave it up for a pinch longer. But we are the burnt orange because, why not hook 'em UT? But you got your burnt orange here of the United States back from 1950 kind of being in the middle. And it's really weird how we're about at the point where all these, the population's about in equilibrium here for Europe, US, China, Japan, and India. Check out Japan. Everybody's just, I don't know if they're just dying or going away, but the reality is their population is just, absolutely projections too, right? So who knows? But at this moment, no doubt the last 20 years there's been a decline in their population. You can see how India is just continuing to take off. Look at that graph. So it's really interesting that U.S. long term, and again, this is a long time from now, but this is, people will still age. The people that are around today are still going to age. So it's accurate for some portion of time, but it's amazing how we are going to have one of the bigger populations of people between 15 and 64. All right, pending home sales, guys. As we've said, activity is slowing. There is no question about that. We know that. We get it. This is another chart showing that as far as what's going on. So 1% month over month, 20% down as far as pending home sales. So again, the activity is going down. Nobody is arguing that. I will say the South is minus 1.1. So there you go. That we're not doing too bad. Here's what I thought about homeownership, guys. This is the net worth. The top 1% of Americans, which is crazy to think about, have a net worth of $10.8 million. That astounded me. 1% is because when they say, the 1%ers, I don't know. I didn't picture them having $10 million of net worth, but there you go. Top 2%, top 5%. So basically the top 5% of Americans are millionaires. Top 10%, they got at least $800,000 in the bank. And the other top 50%, if you will, get about $500,000. But here's the catch, why we're showing this. Not to make anybody feel bad, but on average, 2/3 of this net worth is tied up in their home equity, which is crazy. So home ownership is a great way to build wealth. We all know that. If somebody didn't buy it, because they listened to the headline. So this is my counter, anti-headline, don't listen to them to some degree. This is what on the right side is a chart of what's happened after some major movements in the market, right? So in October 2015, headline, a bubble larger than 2006. Well, the appreciation that year was 5.1%. And this is taken to where if somebody bought a home for $300,000, it's showing you the amount of appreciation they would have realized. So again, it just goes, and I'm not going to read this to you. You guys can look at it, push pause on the video if you want. But we're in a housing bubble, 5.4. Homeowners don't build wealth. Just remember, guys, newspapers, and the fun, happy, good time headlines don't sell as much as the fear mongering and what they do. So even in July of 2021, the boom is over. Guys, that was a year ago. We still had 18% appreciation. As a matter of fact, watch this. So this is Lawrence Yun. Go, Larry. Lawrence Yun, the National Association of Realtors chief economist. So he's actually said some things that I disagree with as of late, but here's what he's saying now, which seems to be more in lines of kind of what we've been saying. In terms of the current housing cycle, we may be close or at the bottom of contract signings. So in other words, guys, remember the data that's coming out right now that says homeowners, this, and this is August, which means the data is from June and July, depending on when you look. Rates peaked in June. So certainly that turned off the faucet pretty quick. This next sentence, or the next paragraph, this month's very modest decline reflects the recent retracement in rates, right? So in other words, rates are going higher, fine. But it does say, in the second part of that paragraph, but limited supply at the lower price points is hindering transaction activity, meaning there's not a lot of purchases right now because there's just not a lot of that lower price point homes. Those first-time home buyers, we've been saying that. Third paragraph, home prices are still rising by double-digit percentages year over year. So they're still rising. We've seen it. We've been saying it. There's appreciation still happening. But the annual appreciation rate should moderate to the typical rate of 5% by the end of this year and into 2023. Guys, here in Dallas-Fort Worth, like for decades, we were like 2 to 3%. 5% is great. That's still a fabulous, fabulous market. Last paragraph. With mortgage rates expected to stabilize near 6% alongside a steady job creation, home sales should start to rise by early next year. I agree. I don't know that we're going to get to 6. I said we were earlier, a couple months ago. We'll see if depends on, like I said, what Jackson Hole announcement comes tomorrow with inflation and things like that. We'll see what they say. But guys, ultimately, Jerome Powell tomorrow, the statements they're going to make, and there's inflation numbers coming out tomorrow as well. If they're bullish, like saying, oh man, we're really going to keep hiking rates and we're going to make sure that inflation doesn't get away. Again, I think everybody's going to love that. Even the stock market, it might take a little hit because ultimately they may say, oh man, like corporate earnings aren't going to be as high. But the sooner we can get inflation at least in check, the sooner we can kind of get back to things as normal. We don't have to worry about the Fed quite as much. So I do hope they go aggressive. If you guys have any questions, again, I know this is getting real techy in terms of or technical, I should say. I love it. So if you guys don't like it, let us know. We can go back to doing some other things. But I like it. Hope you guys have a great day. As always, when you think mortgage, think Mark.